stop scrolling for a second, because if you're watching this, you're probably just as confused as everyone else right now. One minute you got people saying the Toronto market is about to drop 30%, and the next minute you have someone at dinner telling you, if you don't buy right now, you're going to be priced out forever. Then you actually look at what's happening in 2026, and it just doesn't match either story. Prices in the GTA are slightly down year over year, inventory is sitting longer, and the buyers aren't really rushing the way they used to. But here's the part that nobody really explains properly. The market isn't crashing, but it's not really going up either. It's kind of just sitting sideways. The 2026 GTA real estate market is a minefield of conflicting signals and is creating massive anxiety for buyers like you. But what if I told you that your confusion is actually the key to winning in this market? Today, we're going to cut through the noise. We're going to break down the biggest concerns keeping GTA buyers up at night, explain what's really happening, and give you a clear strategy to navigate this market with confidence. This isn't about hype. It's about clarity. Think of the GTA market like a giant trampoline. Underneath, there's a safety net. That's the government side of things. Programs like mortgage amortizations, CHMC support for builders, and even incentives like rebates. In some cases, people are seeing the $130K rebate structure on certain pre-construction deals or incentive packages. I got a full breakdown for the $130K rebate down below. The point is, there are layers of support underneath the market. Every time it tries to fall too hard, something steps in to soften the drop. That's why you don't see a full collapse. The system is designed to prevent one. The government is trying to prevent the housing bubble from popping. But at the same time, there's also a ceiling above us. And that ceiling is interest rates. It doesn't matter how much demand there is. Borrowing money is just too expensive right now for prices to shoot back up like they did in 2021. Cheap money era is gone, at least for now. So when you got a strong floor holding things up and a hard ceiling pressing down from above, you don't get a crash. You don't get a boom. You get what we're in right now, a sideways market, just bouncing in the middle while everyone argues what direction it's going to break next. Let's tackle the first big head scratcher, the invisible rebound. You're seeing headlines shouting the sales activity in March 2026 jumped 30% month over month. On the surface, that sounds like the market is roaring back, but here's how people get misled by headlines. The month over month jump is just seasonality, frozen February baseline. When you look at the actual TREP data for March 2026, the reality is a lot more sobering for sellers. The GTA average home price is $1,017,796. Yeah, that's a slight 0.9% bump from the last month, but it is still down massively 6.7% year over year. The HPI benchmark price, the true measure of a typical home, is sitting at $941,800, which is down 7.4% from this time last year. Right now, we're sitting on 4.3 months of inventory, with homes taking an average of 31 days to sell. This isn't a rebound, it's a recalibration. Now, let's stop talking in feelings and look at the actual math of what this means for your wallet. Imagine you wanted to buy a $1.1 million detached home last spring. In March 2025, with rates sitting around 5.8%, putting 20% down left you with an $880,000 mortgage. On a standard 25-year amortization, your carrying cost was roughly $5,530 every single month. Fast forward to today, March 2026, factoring in the 6.7% year-over-year market drop, the exact same house is now priced around $1,026,300. That is an immediate $73,700 discount on the sticker price. But here's the massive advantage that most buyers sitting on the sidelines are completely missing. Interest rates are now hovering around 4.5% from qualified buyers. With 20% down on that new price, your mortgage is roughly $821,000. At 4.5%, your monthly payment drops to $4,560. You aren't just saving $73,700 on the purchase price, you're saving almost $1,000 a month in cash flow. Over a standard 5-year fixed term, this is $58,000 of pure cash staying in your bank instead of going to the lender. Combine that with lower purchase price, and you're looking at a total financial win of $130,000. But that $130,000 win is only half the story. Because your interest rate dropped from 5.8 to 4.5%, a much larger chunk of your monthly payment is actually going towards the principal. On the 2025 scenario, after 5 years, you paid off about $92,000 of your loan. On the 2026 scenario, even with the lower payment, you pay off over $109,000 of your loan. That means you're quietly building an extra $17,000 in pure home equity just because you waited for the math to make sense. And here's the ultimate kicker, a stress test. Last year at 5.8%, the bank was stress testing your income at almost 8%. You needed a household income of roughly $240,000 to qualify for the $1.1 million house. Today, with rates at 4.5% and the new purchase price, your qualifying rate drops to 6.5%. The income required to buy the exact same house just dropped by another $35,000 a year. The barrier to entry isn't rising, it's actually falling. And if you qualify for the new 30-year amortization rules, the $4,560 payment drops even further down, roughly to $4,100 a month. That is a massive $1,400 per month difference from the peak 2025 pricing. Don't let a 30% jump in monthly sales volume fool you into panicking. With 4.3 months of supply, the data proves that the buyer negotiating power is still completely in your hands. Sideways market isn't a dead market. If you understand the real cost of ownership, it's actually the most strategically favorable time to buy. We're seeing headlines saying Toronto benchmark home prices are back to levels not seen since around 2016. For someone who bought in 2021 or 2022, that probably feels painful, like a reset in value. For someone who's been waiting on the sidelines, it can feel like validation that waiting was the right move. But what that headline actually means is that unwinding of the extreme pandemic boom period, when low interest rates and emotional buying pushed prices far beyond what fundamentals could support. What we're seeing now isn't really a crash as much as a reset, a move out of that overheated phase and into a more controlled but more complex environment. Higher interest rates are now doing most of the work in shaping affordability. Buyers are more cautious, sellers are adjusting expectations, and everything is taking longer to move. So yes, prices have come down from the peak in many segments, but that doesn't automatically mean collapse. It means recalibration. And that's where people get mentally stuck because a reset feels uncomfortable. It removes the idea of easy gains and forces everyone back into thinking about value, timing, and long-term decisions instead of momentum. For new buyers, this does create opportunities that didn't exist at the peak, with more realistic entry points in certain segments. But the trade-off is important. This is not a market where you should expect instant equity anymore. It's a market where decisions need to be based on fundamentals, not hype or momentum. There is something that's not getting enough attention, but is quietly creating a lot of stress for GTA buyers right now. There are estimated 28,000 pre-construction condo units scheduled to close in 2026, and a large number of those condos were bought during the peak in 2021, 2022, when prices was significantly higher. The problem is, in many cases, current appraisals are coming in lower than the original purchase price, and that creates what's known as appraisal gap. That gap means buyers are suddenly being asked to bring in tens of thousands or sometimes even hundreds of thousands of dollars more just to close the property that is now valued lower than what they were originally agreed to pay. This isn't just a financial issue, it's emotional too. It's the feeling of being stuck, of something that was supposed to be a step forward turning into pressure and uncertainty instead. If you're a pre-construction buyer, it becomes really important to understand your options and where you stand before closing. And if you're a new buyer watching this from sidelines, it also changes how you should look at the resale market now, because situations like are part of what's influencing supply, pricing pressure, and negotiation opportunities across the GTA. Another big talking point right now in the GTA is the reintroduction of the 40-year mortgage for the first-time buyers. And it's honestly something that's creating both hype and concern at the same time. On one hand, it can significantly lower your monthly payment, which suddenly makes homeownership feel more realistic for people who were previously completely priced out. But on the other hand, stretching your mortgage over a much longer period means you're paying more interest over time and building equity much slower in the early years, which is where a lot of debate comes in. Is this a lifeline or a long-term trap? The reality is it's neither. It's just a tool, like any tool. It depends on how and why you're using it. For some buyers, especially first-time buyers trying to enter a very expensive market, it can be the only way to get into a property and start building equity instead of staying stuck renting. For others, it might make more sense as a short-term bridge strategy, something used to get into the market now with an intention of adjusting later if rates come down or financial conditions improve. The key isn't reacting emotionally to the structure itself, but actually understanding the trade-offs and making sure it fits into a long-term plan rather than focusing on what the monthly payment looks like today. Let's ground this in real numbers so this actually makes sense. Say you're buying a $1.2 million home in the GTA. In today's market, most buyers are not dealing with extreme rates we saw a couple of years ago. We're generally closer to mid-3s to the mid-4 range, depending on your profile and lender. So let's use a realistic range. At around 4% interest on a 25-year mortgage, your monthly payment is roughly about $6,300 to $6,800 per month. Now, if you stretch that same mortgage to a 40-year amortization, your payment drops closer to roughly about $5,200 to $5,600 per month. That's a difference of almost $1,500 per month. Zoom that out, and you're looking at over $12,000 to $16,000 per year in cash flow differences. And that's exactly why these structures matter. Not because they change the price of the home, but because they change how buyers feel about affordability month to month. But here's what most people miss. Lower payments don't erase the cost. They just spread it out over a longer period. So what you gain in short-term breathing room, you trade off in slower equity growth over time. Last but not least, let's talk about a word thrown around a lot right now, lowball. If you're looking at a home in the GTA that's been sitting on the market for 20, 30, or even 40 days, and we offer 10% below asking, that is not a lowball. That is us aligning with the market while the seller is still anchored to a price that doesn't exist anymore. The reality in 2026 is that the asking price is just a positioning strategy, not a benchmark of value. The data proves it. 74% of the homes in the GTA sold under asking last month. When 3 out of 4 homes sell below the sticker price, the price isn't the truth anymore. It's just a starting point. Sellers are emotionally tied to the 2021 peaks, but the market operates on inventory and carrying costs, not your feelings. With 4.3 months of supply, I'm not being disrespectful when I adjust an offer downwards. I'm being aggressive and protecting my client's capital. But being aggressive isn't just about the purchase price. It's about protecting you from surprises. I don't just show you the sold price. I back every strategy up with a complete closing cost audit, from land transfer taxes and legal fees to the exact adjustment costs you'll be seeing on closing days. My clients know their all-in number before they ever sign a piece of paper. In a sideways market, the last thing you need is a financial blind spot. I make sure you know exactly what it costs to walk through the front door. So when we negotiate the 10% discount, you know exactly how much of that stays in your pocket. I'll be clear. I'm not afraid to submit a lowball offer if that's where the math lands. An agent's loyalty shouldn't be to the listing price. I win these deals by making the seller's carrying costs visible, showing them exactly how many thousands of dollars they're losing in interest and taxes every month that their house stays on the market. In this environment, certainty beats hope. I don't just ask for a discount. I use appraisal risk, real-time data to prove my client's offer is the most logical exit strategy that the seller has. We don't just get attention, we get the deal done at the right price. One last piece of math most people ignore, the cost of waiting. Let's say you decide to sit on the sidelines for another 6 months because you're hoping for another 5% drop. On $1 million home, that's a potential $50,000 in savings. Sounds like a win, right? But let's look at the friction cost. While you wait, you're likely paying $2,500 to $3,500 a month in rent. Over 6 months, that's up to $21,000 gone forever with zero equity. Meanwhile, if you own that home and you'll be paying roughly $1,500 a month in principal, that's another $9,000 in wealth you didn't build. When you add the rent you threw away to the principal, you didn't pay it down. Your 5% wait just cost you $30,000. You didn't say $50,000. You just spent $30,000 to wait for a $20,000 net gain. That isn't even guaranteed. In a sideways market, the math shows that the time in the market beats timing the market every single time. So what do you actually do with all this conflicting information and anxiety? You don't guess, you don't panic, and you definitely don't try to time the market based on headlines. You'll get clarity. And in a market like this, my role isn't to predict the future. It's to help you protect your present and make smarter decisions for your future. First, it's important to validate what you're feeling. If you're confused, frustrated, or anxious right now, that's completely normal because you're getting pulled in every direction by headlines, social media, and opinions that all sound confident but don't agree with each other. Second, you have to come back to your own math. Does the monthly payment actually work for your life, your income, and your comfort level? Not just what a bank says you qualify for. Third, you need hyperlocal insight because the GTA is not one single market. What's happening in Oshawa is different from Oakville. And even within Toronto, each pocket behaves differently. And finally, you have to understand buyer power right now. With roughly 4.3 months of supply in many segments, buyers actually have leverage again. You can negotiate, you can take your time, and you don't have to rush decisions like before. At the end of the day, this market isn't about instant win. It's about making calm, calculated decisions in uncertainty and finding a home that fits your life without sacrificing your financial peace of mind. I'm Sandeep Takar with Remax Realty Specialist. My best advice, stay grounded. Don't watch the headlines. Watch the math. Calculate your numbers. And if you need help calculating, I'm just a phone call away. Make sure to subscribe because next week we're doing a deep dive into the massive supply crunch coming to Toronto and exactly how it's going to affect your buying power in the next couple of years. You don't want to miss that one. See you in the next video.